is 10/16/23, and it is 10:14 a.m. Mr. Dunn, will you please start the roll call?
Yes, and good morning to Ms. Dannenberg. I'd like to welcome her for her first investment meeting here on behalf of Fire Commissioner Kavanaugh. So conducting the roll for Mayor Adams.
Brian Berge, representing Mayor Adams, present.
For Controller Lander.
Allison Hirsch, representing Controller Lander.
John Dorso, alternate trustee.
Okay, and for Finance Commissioner Nyblock.
Kevin Liu, present.
Okay, and for the UFA, Mr. Andrew Ansbro.
Bobby Eustace, Indian Interest Proxy.
And Mr. Eustace.
Present.
Okay, Mr. Christopher Viola. Mr. Eric Bischoff.
Eric Bischoff's present virtually. Good morning, everyone.
And Mr. John Young.
John Young, present virtually.
Okay, good morning. For the UFOA, Mr. Joseph Camastro, Mr. Liam Guilfoyle.
Here.
Mr. Sean Michael.
Here.
And Ms. Barbara Dannenberg for Fire Commissioner Kavanaugh.
Present.
We have a quorum.
Now I'd like to turn it over to the Controller's Office.
Yes, good morning. Thank you. So we have a very short discussion or a continuation of a discussion that was started last week regarding the strategic asset allocation. So with that, I'd like to turn it over to Steve to give some comments, or to Doug if he'd like anything to add, and also encourage the trustees to ask any questions if they have any questions regarding what's already been provided regarding the asset allocation.
So just a quick note, John. Thank you for that introduction. So we've made some great progress with this process. Started in early January with the change in legislation that enabled us to have an expanded basket clause. And I know we've worked very closely with NEPC. I know Doug has gone through a number of iterations in terms of what's possible from a strategic asset allocation, and we appreciate his partnership and support. And with that, I'll just ask Doug to take us through where we are.
Great, thanks. So at the last meeting, I think we went through the presentation in great detail. We presented our preliminary recommendation to make changes, and I know that the presentation is from the last meeting, is also posted to Convene and should be in your hard copy books if you're using those. But essentially, we're recommending that you increase the targets in small amounts to several asset classes, private equity, to the private infrastructure investing and hedge funds, and also to the OFI or private credit allocation. Most of that would come from small adjustments down in a couple of the fixed income categories, including U.S. mortgages, and then also from decreasing U.S. equities. I know we had a pretty packed agenda at the last meeting, and I don't know if there were discussion items or if people have had time to go through it since then and have any questions about any of the categories. I would encourage the group to, I know there's a lot in the recommendation in terms of small changes, but you can kind of break it down and talk about some of the big ones are, is the board comfortable having a slightly higher target to private equity, increasing that from 8 to 10? You're already over the 8%. I think generally that asset category has performed very well for you. You have a great implementation, access to top tier managers, scale, lower fees. And so for us, it makes a lot of sense. I know we've had some discussions in the past about, the peer rankings. I think it is moving you towards more of a, where your peers are for state and large city pension funds that are over, say $10 billion. Most of them have moved to something closer to 10 or 12% to private equity. So that's one part of the component of it. Is the group comfortable with that? Obviously, the basket clause, having that extra 10% relief or flexibility with that new basket clause implementation gave us a an opportunity to look at every asset class. Private equity is one that falls into the basket, and we're very comfortable going to 10. Similarly, looking at some of the other categories, I think in the credit space, while not always hitting the basket, high yield is something that's become much more attractive in the last 18 months with both higher rates and wider spreads. And so that was something that we're very comfortable with. We actually position that to offer a higher return than US equities right now, and are very comfortable given that even though we may be heading into a recession, the pricing in that market is already starting to reflect that risk. And so you're getting rewarded for that extra risk. And, one of the things we like about high yield is the fact that the return is, 95% of it comes from the yield on the portfolio. So it's not about price appreciation. It's really about collecting that money every quarter and recycling that into the portfolio. And then the last one I'll kind of highlight that does fall in the basket is private infrastructure. Again, that's something you started about 6 or 8 years ago. We started really with a 1% target, and we increased that to 3%. The portfolio has been built out very deliberately. I think it's offers some differentiation relative to real estate. And it is also a mix of income producing and appreciation that has more of a longer term time horizon and does align well with the pension fund. And so we're recommending to increase that from 3% to 5%. If you look in the presentation, it's our presentation, page 12, where we have the recommended allocation. So I don't know if there's questions or areas the board wants to discuss or explore further, or other alternative policy mixes that you're interested in seeing.
Press it just one. Check.
Thank you. Just one or two other notes. Doug, I know we talked also about having a formal allocation of cash. It's just 50 basis points plus or minus. And that's really just a recognition that we always have some level of cash in the portfolios to meet benefit payments or to meet capital costs for private assets. I'd say the other tweak that we're requesting is a combination of core and non-core under one allocation versus breaking them out separately. And that just provides a little bit more flexibility for the private real estate team.
Are there other questions at all?
Liam, I see you're.
So
Alert Chief
I had spoken to Doug about this, and Bobby and I had a conversation as well with the rest of the board, just asking for different mixes. In a conversation that we had with Doug, and actually have it here, we asked comparatively what other funds do, similar in size or similar to us, and most of them seem to be somewhere around 13% in PE, where we've been at 8%. I know that was a basket clause constraint. So we've asked for a model that shows us with possibly 12% in PE rather than 10% in PE. And we've also looked at the possibility of lowering hedge funds in order to accomplish that. So Doug is aware of it. He said that he would work on getting us those options. I do appreciate the cash option. And one of my questions on that is when you do an allocation like that, where I know that cash is usually the one place that really doesn't benefit your portfolio right now. It seems like there are a lot of opportunities for us. If we were to make an allocation of, say 0.5%, yeah, 0.5%. Obviously, that would only be done strategically and when it was best for the portfolio.
Yeah, so it's not tactical, Liam. So it's not like you have a 5% allocation and we're timing the markets moving in and out. It's just there to execute. It also facilitates the rebalancing we do every week. So we don't necessarily rebalance equity and bonds every week, but we review it every week and we look at the cash needs and how we need to raise cash. And at that time, we'll figure out if we do need to raise cash, how to raise it to optimize around rebalancing. I'm looking at John Mercer because he's been at this for a long time, but obviously with the biggest asset class, that fixed income, the public market, that's how we go through the process.
So Steve, it may just be worth mentioning that the short-term desk as it exists today manages not only the pension a small piece of pension assets, but also the larger city treasury, there are constraints on what that portfolio can actually invest in. So, and I think that's the piece that is kind of in the weeds, but just so I think you should take some comfort in the fact that there is, for lack of a better term, a basket clause for the short-term desk that would actually, keep the cash investments in high quality paper and other things. And I would defer to most of the investment staff. But I think that that's a piece that folks should just be aware of. It's not like they would be taking risk with the cash piece. It would be very much managed to short-term instruments and literal cash.
Yeah, we've actually gone through a process. We actually, so we've always been good on the execution piece of cash under Owen Tunney. But we wanted to have more of a rigor around portfolio management. So we hired a gentleman named Chris Holmes, who actually joined us with an 11-year background at Moody's. He was a director in fixing, and has got great skills. So we're very cautious, very careful in terms of the credit exposure. Again, the expectation for your fund would be to manage things within a month, probably within 2 weeks. They're really just there for liquidity, that cash. But in aggregate, right now, it depends on where we are at the New York City municipal issuance, but we have about 30 billion in cash under management. Only about 3.5 billion of that is for the 5 public pension plans.
And can I ask a question? We had just concerns about assumptions that we like stick out. We stick out, or your assumptions for U.S. large cap is so bearish, and emerging markets is so bullish that it seems we're out of, with all the other consultants, we're out of line, and not closely out of line. We're 5.4 versus 7.3, 6.7. Just seems like that's going to take us in a different path, but steering the ship in a completely different, not totally, but a different trajectory.
Well, the assumptions feed into the process, and they certainly reflect the bias. So I completely agree with that. The assumptions, the thing that we've found are important is the relationships between the key assumptions for stocks, bonds, cash, and then the private markets. And so while ours is lower, and I think only one of the other consultants is in the neighborhood of where we are, the others are still all below. I think they're all below 6.5%. So we're definitely an outlier. But because the relationship kind of still falls in between the other categories, that number reflects a bias and is reflected in the projected return for the whole prior pension based on these policy portfolios we modeled. We still think that it's the largest piece of your portfolio. We are recommending trimming it because we think it is overpriced right now relative to history, but also, looking at one of the things the market's kind of exploring right now is bond rates have come up, right? The market always compares bond yields to earnings yields, and the earnings on the S&P, if you look at it like a big basket, has been between 6 and 7%, and now bond yields have come way up, and earnings aren't expected to glide a lot higher. And in particular, if we hit a recession, that's where you could see a correction. It's still the biggest piece of your portfolio. We're only recommending trimming it by 4% or so, 5%. And part of the reason we're trimming it is because we're going to allocate to private equity, which is a higher returning category, private infrastructure, which we have as a higher returning asset category as well. And then high yield bonds and private credit, or OFI, which, I think right now it's hard to argue that those don't have higher return expectations, given where the market's pricing credit and how the dislocation that has started to develop is creating opportunities.
Just to add to that, so I'm just to echo what you just said. So the equity risk premium right now is at a 20-year low. That's a fancy way of saying what the expected returns are in equity, less the risk-free rate, typically U.S. 10-year treasuries, is at a 20-year low, that differential. So equities don't look that attractive right now. You really want to invest when the equity risk premium is at a much higher level.
So my question, based on what Sean is asking, is if you do trim it by 5% and things seem to be turning around, how quickly can you react to that change? And does that require us coming back to this room to make that change to this asset allocation if the world turns?
Well, can I take a shot at it first, Steve? The first thing is three of the categories that we're recommending you shift money to are private markets. So you're going to remain invested in equities and glide to those long-term targets because we're not going to be able to flip the switch and put more, 2% more in private equity or into infrastructure or even the private credit. So we're setting the target as a baseline, and we glide to that over time. I would agree that we're not nimble at this board where we could, shift around. And the other part of that scenario is, would we be adjusting after the market does well? Because when the market does well, we generally, like today, part of the reason our assumption is very low is since COVID hit, the equity market is up tremendously. And earnings are up too, but they're not up as much as the market is kind of, the market is pricing future growth. And we think that it's, a little bit out of whack right now. It's a little bit overvalued. And I think, if we hit a recession, you'll obviously see that kind of play out. And that isn't necessarily the basis for our recommendation. It's really just looking at the history and that earnings yield, that risk premium, equity risk premium that Steve.
Sorry, did you want to ask?
Yeah, no, okay.
So, we were gonna make a request that I think bears a relationship to some of the questions that are coming around the table today. And look, I know you can do a million billion exercises, so I don't want to overburden you, Doug. But we were curious to get at this kind of equity question in a kind of more general way, and that is as follows. We were curious to see what an optimal portfolio would look like if you hold equity, like the overall category, the umbrella category, at the current policy level of 50, and then, let your optimizer play out with that being held as a constant. Because I think we just want the data point just to see comparatively, understanding your assumptions are what they are. And I think a lot of your reflections on the market make a lot of sense, more than I'd be able to come up with my own. But just to see what the extra risk looks like and the extra return looks like when we have that held constant.
Absolutely willing to do that. I think, the key question when we do that is if we leave the public equities in place and then still want to increase the private markets and private credit and high yield, then we'll be taking it more out of the lower risk.
I'm not saying necessarily, like my read of your document is that equity as an umbrella category includes private, right? So if it turned out that the optimal portfolio with 50%.
Yep. So you're saying that's okay to shift from public equities to private equity. The other 3% is coming from
I want to be as flexible
categories.
as possible about this because I don't have any particular call in any particular asset class.
No, and it's interesting because we talked a little bit about peers when there's different discussions. Your peers are still above 50% in public equities, and when you add private equity, it's probably over 60. But the other categories you have exposure to, the hedge funds make a difference. I know you guys serve on all the boards. The police and fire have the hedge funds, that allocation. If you think of hedge funds, right, they're a mix of stocks and bonds, really. They're just implemented differently with long and short positions. So having that 5% in equities, or hedge funds rather, is part of the reason that we're there. So it does dovetail, the discussion you're asking for does dovetail with the idea. Do we cut back hedge funds and look at some mixes that have that 50%, threshold, including private equity still in place? And then, the other one I think that Liam asked is to, increase private equity and that within that. So we can look at both. We can look at, keeping the 10% private equity and just putting it back into public equities, or doing 12% private equity and getting back to 50. And then it would likely come from hedge funds or some of the
I don't have any.
No, you just want to examine
a priori interest in where it comes from. I'm just curious what your model spits out when equity in its broadest heading is held constant.
Yeah, I do want to kind of make a point about the model, right? We do the optimization model as an exercise, right? And the model in my view is a crude tool, right? You're putting in all your inputs and you're saying maximize return for every different point on the risk spectrum, right? And so we did that as part of exploring where we were going to end up. But the key part of the model when you go through that exercise is you end up putting the constraints on it. And at some point, you put maximums, you start out with maximums. Well, the maximum we'll ever put in private equity is 15%, we'll put that there. Hedge funds, we would never go more than 10, et cetera, et cetera.
Yeah.
And then you start putting in minimums, and the next thing you know, you're just really manipulating the process. And so it is a subjective discussion, with the starting point being where you are and where we're comfortable going with each category. And with private markets, we're comfortable going a little bit higher because we think this fund has a lot of liquidity. Your private equity portfolio in particular is very mature. It spits off cash, right? I know we're trying to grow it, but it's the highest returning asset class in your overall basket of categories. And because your portfolio is mature, it flows cash back to you. And then obviously you have the liquidity coming from the city and from the employee contributions.
Yeah, no, I hear you then, Doug. So I guess I'm modifying my request. I don't want the raw optimizer out.
Yep.
I want whatever
Yeah.
process you
We'll
follow.
put together, we'll put together 4 or 5 more mixes to bring to the November 6th meeting. We'll get them to you in advance so that you can look at them. They're very easy to run. I think I've got the feedback from the group. It sounds to me like you're comfortable with 10 for private equity, so we'll look at 10 or higher. And we'll look at keeping that equity ratio, including private equity, around 50, which I think is a very reasonable ask.
So I just want to say, while I'm intellectually curious about what all of the consultants have as their assumptions, I am very mindful at this board that NEPC is the only one that's acting as a fiduciary to this fund. So while I find it intellectually my intellectual curiosity about what the other funds that we might sit on is interesting to me, I'm always mindful that their allocations are for specific clients with different liabilities, different assets, different objectives, maybe similar, but somewhat different objectives than we have at this fund. So I just want to remind folks that I think we're aware of, we're definitely aware on the city side because we sit on multiple boards, but that the NEPC numbers or the assumptions are really what is paramount for this conversation at this board. So I just want to be mindful of that and just make sure that we're all abundantly clear that the only one of the 5 consultants, with all due respect to them, that has a fiduciary obligation to this fund is NEPC, and the other specialty consultants that are directly hired by this fund. So I just wanted to put that out there while we're in public session. I think it's important to make that delineation.
Yeah, I think those are all excellent points, John. So we share the 5 capital market assumptions of the 5 general consultants across the plans. We also averaged them. That was really just an FYI exercise. No one has a crystal ball. No one really knows what the future holds. But we do look for a consistency that I think Doug talked about in terms of how things flow into one another for any one of those assumptions. So.
Yeah, and I just would also point out that analysis was done with the numbers as of December. We updated for the last meeting, we were using our June assumptions. And, candidly, the market moved a bit in the 3rd quarter. Equities moved down, which makes our assumption likely to go up because they've gotten more attractive relative to a year ago or 6 months ago. And then bond yields have moved further too. And high yield spreads have gotten a little bit more attractive. So we will put our 930 numbers in the assumptions, make you aware of the changes in those. Again, they're all relative within kind of a range of within each other, relative to each other. They stay typically range bound. But it does impact that bottom line number, which is the expected return, which is relevant to your 7% actuarial target that I think everyone is very mindful of, right? So we'll put that together in the next week or so, get that posted the 2 weeks prior to the November 6th meeting so that everyone can digest it. Hopefully we can, complete the discussion in November or explore any of the other remaining questions.
John, the thing is, again, I know you're saying they're fiduciaries of their funds. We wouldn't be doing our jobs if we weren't at least looking at the other funds, and we're divergent by multiple points off of our assumptions 5.4, others have 7.7. That's a huge difference in the numbers. We're going to 9.6, and what is over the history of emerging markets has been underperforming U.S. equities forever. I mean, right? It's been an underperforming asset class forever. It just seems like we are the heaviest by multiple points in the same asset class. it's, if we're not looking at it, then we're not doing our.
No,
Yeah, no, I'm
I'm
just
not,
saying,
I'm not disputing that. I'm just
Yeah.
saying that, the other consultants are charged with looking at the assets and liabilities of their fund as they do this and what their assumptions are. What I'm saying is,
they're
that
looking at expectations
NEPC
also.
has a look through to what actually happens at this fund that not every other consultant may have. So, within fairness, I don't think this is a commentary on NEPC or the consultants. I'm just making the broad statement that, that their assumptions, they're not, they're not gospel, for lack of a better term. They're subject to an opinion of economists that look at the market and can make some determinations. So while I respect that there may be outliers and at different boards when it
We're
comes
the
to
outlier.
different
Yeah,
different numbers. I respect that exists. What I'm saying is, having gone through this process this is probably the fourth time in my career or fifth time when we've gone through this exercise. There have been ebbs and flows. If I look at all five systems from 20 years ago to today, there's always going to be periods where, depending on when they struck the value, when they looked at it, as Doug mentioned, some of those numbers are from December, some would be updated to September. I'm just saying that there's rationale in there that we may not be capturing, but I don't know if we've looked at everything apples to apples on that sheet, considering that there's additional information that NEPC has run. I don't know if all of the other five systems I'm sure BAM knows that, but I don't know if that is relevant to the conversation that we have as a board here. That's, if that makes sense. That was.
And I can address that equity valuation again further, spend another 5 minutes on it at the November meeting. Because I can show you how we kind of come up with that, because we have a lot of backup material to kind of, just give the board some more context.
And you know what, I think that would actually be really helpful at the November 6th meeting, is if that would satisfy, I think, the question on how you came up with those assumptions and why you have a different view of the world than the other consultants do. And look, I'm also mindful, we have 5 general consultants. There are probably 50 general consultants in the universe that all have 50 different ideas about where things are going. So, I am just mindful of a very small sample and having outliers of a small sample.
But just for my own edification, when you look at the numbers to the left, those are the 5 general consultants. When the general consultants and the specialty consultants seem to be off by 3 points, and in some instances, 6 points, does beg the question.
Yeah, the specialty consultants are a little bit of an outlier in that they don't necessarily think in the same. I think the way that they were asked for that information probably was the context of what are their general expectations. I don't think that they have an asset allocation team that does capital markets modeling. Aon may, because they own Townsend, but generally, I think the way that they think of that, answering that question, is a little different than the way the other 5 general consultants think about it. But we're absolutely happy to address the differences and kind of show you that they may impact the projected performance, but they're not really impacting that much the recommended targets, which I know sounds a little crazy, but so I want to kind of allay that concern in that we're still looking at the whole portfolio holistically, looking at our assumptions. For example, private equity, our assumption is still 10%, but I think if you ask the BAM team what they expect from private equity, and we know what you've earned is, mid-teens, it's really about the modeling exercise and not about trying to project exactly what you're going to get from that over the next 10 years, right?
That's exactly right. Also, the input from the specialty consultants, might be a little bit of them talking their games, that they expect their assets to outperform. But I think the other key volatility estimates, which tend to be lower, and what they do is focus on observed volatility versus something that's implied. If you were to use the observed volatility because of the mark-to-market conventions in privates, and the expected higher return, and put that into an optimizer, it's going to kick out a portfolio. It's got a much higher allocation to private equity. So correct me if I'm wrong, Doug, you typically massage those volatility expectations for private assets higher.
Yep.
So that the optimization doesn't spit out
Right.
such a high level of allocation to those assets.
Right.
We're constrained anyway with the basket clause at 35%. Probably you wouldn't want to go to 35, 33%. But there might be more you can do there in a prudent way.
Yeah, and the recommended mix we have now goes to 33, so we'd have.
Yeah.
At least a 2%
Buffer. Yeah.
buffer.
So there is just one other thing that I just wanted to answer a question that was raised at the last meeting regarding the administrative code and the 45%. And I just want to let everybody know, I did confer with the law department that all equities are treated equally. So my concern in asking the question was that private equity would be treated differently than public equity. There is no delineation, so we do not have the risk on any of these models of dropping below the 45%. So I just wanted to circle back with the board and just make everybody aware of that. And I'm sure if you need to hear from the law department, you can hear from them too. But it doesn't seem like it's a concern just based on.
And Doug, if I'm understanding your point correctly, you're essentially, even though you're saying that you guys believe emerging markets are going to be outperforming, you're still keeping our
Right. We did.
at 6%.
Yeah.
I get it.
We didn't recommend increasing the target percentage, but we are effectively, by lowering the US, we're kind of tweaking that mix within your global equity, public equity portfolio a little higher, right? And so we had the bet in place, if you will, the last time around, going to 6%, and we're keeping it in place because we think that it makes sense long term. You know, equity markets are cyclical, right? Meaning there's been these periods where the US crushes it, and then there's periods where, in part, when the dollar is weaker, that the non-US equities do better. And some of that's also driven by valuation cycles and economic cycles, and they're very hard to predict. I know the dollar strength is something that we have benefited from for more than really since World War II, certainly since the 70s. There is, with the emergence of China and some of the other geopolitical events, there is a movement away from some of the things that benefit the dollar, like trading oil and non-dollar currencies, other things where we've used the dollar in that positioning politically in the globe. That has led others to try to say, let's try to get away from the dollar system a little bit. That's a long slog to change that trend, but it's something that we pay attention to and think about when we think about our assumptions.
And those are some of the long-term things that as board members, I would encourage you to think about is what are the longer-term trends? The dollar, our deficits, our ability to continue to run these deficits, these levels, and the impact on rates. So, Doug, I understand that, and maybe not with NAPC exclusively, but about 25% of the public pension plans out there. So what gave rise to the need for us to look at the strategic asset allocation review was the change in the basket clause legislation. Notwithstanding that, about a quarter of all public pension plans are going through this exercise of strategic asset allocation review because of the significant move up in base rates. You think back where we were in March of 2020 at the outset of COVID, 10-year treasury yields were at 51 basis points. They're at 470 today. They were as high as 488 2 weeks ago. And there are some concerns that there's some market technicals that are longer term that may create, may leave those rates higher for a lot longer. That's right.
And honestly, that's good for a pension system like
Yes.
yours, right?
Well, I would
I know-
assume that allows us to earn our 7% with a lot less risk.
That's right. That's right. And Steve, as a former fixed income portfolio manager, he hides his giddiness under his suit. But when we're back to a real bond market where you can earn 5 or 6% from bonds, and that's a much higher rate than the level of inflation, we're all, I think, better off for that. But it's been a little bit of a bumpy ride so far, and we think there's probably some more bumpiness ahead. So that's still something that is a good long-term trend.
So then, just again, for our own edification, the push towards privates rather than publics is basically does that come out of the fact that the banks are pretty much on the sideline right now? So that's really where the only game is?
Yeah, there are a lot of things that came out of the global financial crisis in terms of regulatory reform, and Dodd-Frank being one of them, Basel legislation for banks that has actually made it more difficult for banks actually to position in certain asset classes. Their balance sheets are somewhat constrained through the supplementary leverage ratios, not to get too technical. But yeah, they're putting a lot less on their balance sheet these days. So the private markets have been the beneficiaries of that. We also had a presentation. I'm looking, we have the privilege of having Anash Kajello as our head of private equity in the room, but we had a presentation with one of our primary managers last week. And he made a very interesting just case about how private equity is simply a better business model than public. You can choose your board of directors, you can choose your executive management team. You can align the interests with the employees to be much more favorable, to generate long-term value creation. So I buy into that. I think that still makes sense. And Ash, correct me if I'm wrong, but as things have cheapened up a little bit, we still have a lot of confidence in our ability to put money to work in private equity. Right? We're to your point earlier, we have a lower allocation than a lot of our peers. Our peers have been less able, less willing to commit more capital in that space. So we're able to get into deals that we maybe previously couldn't get into with better economics. And you really want to put money to work when things are slightly or very much disrupted, because that will drive longer term performance.
Sure. Anash Kajello, the Comptroller's Office. Just one quick thing I wanted to add is we're also in a position of strength because most other LPs and large public pension plans are over their targets, as we are. But they're starting at a much higher base, so they're constricted and they can't commit as much capital, which means we can be a more meaningful investor going forward for a lot of the managers that are, some of the best in our portfolio.
Comment on the point Doug made earlier. Very good point. We have a mature private equity. It's not a lot of good times, a lot more, but still have cash flow coming in. So in order to put money to work, there's a lot more you have to buy in the market today to get the cash.
Yeah, that's true. I don't think I have much more to add to that. We continue to have distributions every quarter coming out of the portfolio. So.
Right. Any other questions? So Doug, I think you have your marching orders as far as what folks are looking at as far as mixes. I would encourage anybody that if you have something that occurs to you after the meeting that you'd like Doug to run as a scenario, I think just as a courtesy to the rest of us, if you could just let everybody know what other scenarios he may be running, just so we're all on the same page. So when we get here on the 6th, we can have a really thoughtful conversation about where we think we're gonna go. I think that would be just helpful. I'm mindful, and the reason that I say that is at the turn of the year, BAM is going to create their pacing plans and come back to the board. So if the longer it takes us to get the strategic asset allocation done, the longer it would take for us to or I should say take BAM to run the appropriate analysis if we were to increase private equity or increase an asset class or decrease an asset class, because there is some work that needs to be done with the Bureau of Asset Management and the specialty consultants in order to make sure we can deploy those assets. So it's not, I don't want the board to feel like you're under the gun, but at the same time, I'm just mindful that there's a lot of other pieces that hinge on the strategic asset allocation. So I just want to be mindful of that. So if we can wrap it up by the end of the year, I think we'll all be in a better place as we get into 2024.
That's one thing, we're going to see a mix that will be showing hedge funds reduced or neutral, not increasing, right? That we talked about, that was kind of a.
Yeah, so we'll go back to the current target and then model some that decrease it and then look at some with zero hedge funds is what I'm hearing.
That's great, man.
So we'll look at a series of things.
That's great, thank you.
So if there's no other questions regarding the strategic asset allocation, and I believe there's no other items for public session, I'm gonna make a motion that we exit public session, and enter into executive session.
Second.
Okay. In absence of the chair, all those in favor? Aye.
Aye.
Any opposed? Any abstentions? Hearing none, the motion is carried. So I will ask Bam to just cease the recording. And I would,
All right. During the executive session, the board discussed various investment matters, some personnel matters, and we need a motion to adjourn.
so move John Dawson.
Second, Liam Guilfoyle.
Aye. Fourth of aye. Okay. Yes. Yeah. Please.